The dollar just crashed to a 4-year low, down 11% in a single year. Meanwhile, Nasdaq surged 20%. Big tech companies are getting richer from the very collapse, destroying your savings. The biggest wealth transfer in 50 years is happening right now. And if you don't understand the mechanism behind it, you're on the wrong side of that transfer. Here's what nobody's telling you. When the dollar falls 11%, your $100,000 in savings just lost $11,000 in purchasing power. Automatically. No market crash required. No dramatic headline. Just a quiet, systemic erosion of everything you've worked for. But Microsoft, Apple, Nvidia, Amazon, and Google, they're not just surviving this collapse. They're engineering profits from it. 40% of their revenue comes from international markets. When the dollar falls 11%, that foreign revenue converts to 11% more dollars. Same products, same customers. Bigger numbers on the balance sheet. That money has to come from somewhere. And I'm going to show you exactly where it's coming from, why this isn't an accident, and what happens next. My name is Alex, and I've spent the last decade tracking currency markets, central bank policy, and the mechanics of how wealth moves from regular people to massive institutions. I read Federal Reserve reports and sovereign debt filings so you don't have to. And what I'm seeing right now is a pattern that's happened twice before in modern history. Both times, it preceded a massive redistribution of wealth. If you want to understand what's actually happening to your money right now and how to position yourself on the right side of this transfer, make sure to hit that subscribe button and give this video a thumbs up. Before we dive in, I want to know, what's your dollar collapse prediction? Do you think it stabilizes from here, or are we just getting started? Drop your take in the comments. I read every single one. Here's what I'm going to show you today. The dollar collapse isn't a bug, it's a feature, and the companies profiting from it have a structural advantage that turns currency weakness into automatic earnings growth. By the end of this video, you'll understand the exact mechanism, why it's accelerating, and what assets benefit when the world's reserve currency loses purchasing power. Let's start with the numbers everyone's ignoring. $38 trillion. That's the United States national debt right now, not 38 billion. Trillion. With a T. If you break that down per person, every single American, including children, owes over $100,000. Per household, $285,000. That's more than the median home price in most of America. The debt to GDP ratio just hit 126%. Translation: America owes more money than the entire economy produces in a year. And here's where it gets worse. The government is paying $3.3 billion per day just in interest, not paying down the principal, just servicing the debt. That's over $1.2 trillion per year in interest payments alone. Now, here's the question nobody wants to answer. How do you pay back debt when you're already spending more than you earn? You can't tax your way out. You can't cut spending fast enough. There's only one option left. You devalue the currency. You print more dollars, which makes each existing dollar worth less, which effectively reduces the real value of your debt. This isn't new. This is the playbook. And we know it's the playbook because they've told us it's the playbook. August 15, 1971. President Nixon announced that the United States would no longer convert dollars to gold. He called it temporary. 54 years later, we're still waiting for temporary to end. That was the moment the dollar became a purely fiat currency, backed by nothing except the government's promise that it has value. Since 1971, the dollar has lost 87% of its purchasing power. $100 in 1971 has the purchasing power of about $13 today. Let that settle in your mind for a moment. 87%. If you held cash for the last 50 years, you didn't preserve wealth. You incinerated it. But that's not even the most aggressive move they've made. 1985. The Plaza Accord. The G5 nations, the 5 largest economies at the time, gathered at the Plaza Hotel in New York and made a coordinated agreement to deliberately weaken the US dollar, not accidentally, not as a side effect of monetary policy, deliberately. The goal was to fix America's trade deficit by making American goods cheaper for foreign buyers. It worked. The dollar fell, exports rose, and American savers paid the price. What I'm about to show you next is the part that took me years to fully understand. Because on the surface, dollar devaluation seems like it hurts everyone equally. It doesn't. It creates winners and losers. And the winners are the ones who understand the mechanism. When the dollar declines 11%, cash loses 11% of its purchasing power. Bonds, especially long-term bonds, get destroyed because inflation erodes their fixed returns. But equities, specifically large-cap multinational tech companies, they don't just survive, they thrive. And here's why. Microsoft earns approximately 40% of its revenue internationally. So does Apple. So does Nvidia, Amazon, and Google. When a German company pays Microsoft for cloud services, they pay in euros. Microsoft then converts those euros to dollars for their financial reporting. When the dollar is strong, that conversion hurts them. 100 euros might convert to $90. But when the dollar weakens, that same 100 euros suddenly converts to $110. Same product, same customer, same sale, more dollars. Automatic 11% revenue boost from foreign operations without selling a single additional unit. Now, combine that with something even more powerful. These companies have pricing power. Businesses can't just cancel their cloud computing contracts. They can't stop using Windows licenses. They can't abandon AWS infrastructure. These aren't discretionary purchases. They're mission-critical operating expenses, which means Microsoft, Amazon, and Google can raise prices during inflationary periods, and their customers have no choice but to pay. So you're getting two compounding effects. Foreign revenue converts to more dollars, and domestic revenue grows because they can raise prices in an inflationary environment. Cash is losing value. Tech stocks are compounding gains. But there's a third layer that makes this even more powerful, and this is the part most investors completely miss: share buybacks. Microsoft had 8.5 billion shares outstanding in 2012. Today, 7.43 billion. They've been systematically buying back their own shares and retiring them. Nvidia did the same thing. They went from 25 to 26 billion shares down to 24 billion shares. Here's why that matters. Dollars can be printed infinitely. The Federal Reserve can create new dollars with a keystroke. But shares of Microsoft, they can't be printed. In fact, they're being destroyed. As the supply of dollars increases and the supply of Microsoft shares decreases, the relative value equation shifts. Scarce assets rise, abundant assets fall. Gold just hit all-time highs, silver surging, Bitcoin's climbing. And big tech stocks are outperforming everything. These are not coincidences. These are the assets that benefit when fiat currency loses purchasing power. They're the escape hatches. And institutional investors know it. Now stay with me here, because this next part is where most people check out, and that's exactly when they miss the most important insight. The psychology of currency collapse is different from a market crash. A market crash is visible, dramatic. You see your portfolio drop 30% in a month, and your brain screams at you to do something. But currency devaluation, it's silent. It's slow. It's a tax you don't see because the number in your bank account stays the same. You still have $100,000. It just buys 11% less. Your brain isn't wired to panic over that, which is exactly why it's so effective. By the time most people realize what's happened, they've already lost years of purchasing power. And here's the cruelest part. The people getting hurt the worst are the ones trying to do the right thing. The ones saving cash. The ones staying liquid in case of an emergency. The ones avoiding risk. Meanwhile, the people who own scarce assets, the people who hold equities in companies with international revenue and pricing power, the people who understand that cash is a melting ice cube, they're watching their wealth grow in real terms even as the dollar number stays flat or rises modestly. This is the wealth transfer, not from poor to rich, from the financially illiterate to the financially informed, from people who think in nominal dollars to people who think in purchasing power. We're halfway through, and honestly, the best part is still coming. Because now I'm going to show you exactly how the system is designed to keep you in cash and out of assets. Every financial institution, every bank, every brokerage, they all have cash management accounts. They pay you 0.5% interest on your savings. Maybe 1% if you're lucky. They call it safe. They call it liquid. They call it smart. And technically, they're not lying. It is safe from market volatility, it is liquid, but it's not smart. Because while your cash sits there earning 1%, inflation is running at 3 to 4%. You're losing 2 to 3% per year in real purchasing power. Guaranteed. But they don't tell you that part. They tell you stocks are risky. They tell you to keep 6 months of expenses in cash. They tell you to dollar cost average slowly into the market. All of which keeps your money in their system, earning them spread, while you lose purchasing power every single day. Now, here's the thing most financial advisors will never admit. Cash has a role, absolutely. You need liquidity for emergencies. You need dry powder for opportunities. But the idea that 20, 30, 40% of your net worth should be sitting in a savings account earning 1% while the dollar loses 11% per year? That's not financial advice. That's wealth destruction with FDIC insurance. And let's talk about bonds for a second, because this is where it gets even worse. Bonds are supposed to be the safe part of your portfolio, the stable allocation, the thing that protects you when stocks fall. Except when inflation rises and the dollar falls, bonds get destroyed. If you bought a 30-year Treasury bond paying 2% interest back in 2020 and now inflation is running at 4%, you're losing 2% per year in real terms for 30 years. Locked in. Long-term bonds are one of the worst performing asset classes in a dollar devaluation environment. And yet, that's exactly where most retirement accounts, pensions, and conservative portfolios are heavily allocated. Because the advice was written in a different era, an era when the dollar was stable, when inflation was low, when bonds actually provided protection. That era is over. And the people still following that playbook are getting quietly destroyed. Now let me tie all of this together, because when you see how these pieces connect, the entire picture becomes clear. The United States has $38 trillion in debt. It cannot be paid back at current dollar values. So the dollar has to fall. Not might fall. Has to fall. It's the only way out. When the dollar falls, savers lose purchasing power. But companies with international revenue, pricing power, and scarce shares outstanding, they benefit. Their foreign earnings convert to more dollars. Their products become more affordable to international buyers. And the relative scarcity of their shares compared to the abundance of dollars makes their stock price rise. This is why Nasdaq returned 20% while the dollar fell 11%. This is why tech stocks are hitting all-time highs while your savings account loses purchasing power. This is why gold and silver are surging. They're all scarce assets in a world of infinite dollars. The mechanism is simple. The dollar is being systematically devalued to reduce the real burden of government debt. That devaluation transfers wealth from people holding cash to people holding scarce assets. And the companies with the strongest competitive moats, the biggest international footprints, and the most pricing power are the ones capturing the largest share of that transfer. You're not watching a market rally. You're watching a currency collapse in slow motion. And the people who understand that are positioning themselves accordingly. Almost there. But before I wrap up, I need to show you how all of this works together as a system. Because it's not just about owning stocks, it's about understanding which stocks and why. Not all companies benefit from a weak dollar. If you're a purely domestic company with no international revenue, dollar devaluation doesn't help you. If you're in a commoditized industry with no pricing power, inflation squeezes your margins. If you're issuing new shares constantly to raise capital, you're diluting shareholders and destroying scarcity value. But if you're a company that earns 40% of revenue internationally, has pricing power because your product is mission critical, and is actively buying back shares to reduce supply, you're not just surviving dollar devaluation, you're weaponizing it. Microsoft, Apple, Nvidia, Amazon, Google. These aren't just tech companies, they're currency hedges, they're inflation beneficiaries. They're scarce assets with global demand and pricing power. When the dollar falls, they win. When inflation rises, they win. When capital flees from cash and bonds into equities, they win. This is why they've outperformed every other sector. This is why institutional investors keep piling in. This is why they're trading at premium valuations. Because in a world where the reserve currency is losing purchasing power, these companies are the closest thing to a safe haven. And here's the final piece that makes this all come together. The Federal Reserve can't stop this. They're trapped. If they raise interest rates to defend the dollar, they blow up the economy and make the government's debt payments unsustainable. If they keep rates low, the dollar keeps falling and inflation keeps running. There's no good option, only bad and worse. Which means this trend isn't temporary, it's structural. The dollar will continue losing purchasing power, scarce assets will continue rising in nominal terms, and the wealth transfer will accelerate. The question isn't whether this is happening. The question is whether you're positioned on the right side of it. Your future self is counting on you to understand this, to see past the nominal dollar values and recognize what's actually happening to purchasing power, to stop thinking of cash as safe and start thinking of it as a depreciating asset, to recognize that in a world of infinite dollars, scarcity wins. 10 years from now, you'll look back at this moment and realize you had a choice. You could hold cash and watch it lose value, or you could own the scarce assets that capture the wealth transfer. The people who choose correctly don't just survive dollar devaluation, they profit from it. Precious metals, inflation, the Fed, tech stocks, currency collapse. What topic do you want me to break down next? What's keeping you up at night that nobody's explaining properly? Drop it in the comments. That's what this channel is for. Understanding the system so you can position yourself correctly. The dollar's falling, your savings are losing value. But now you understand the mechanism. Now you understand why big tech is winning. And now you understand what assets benefit when fiat currency fails. The boulder isn't pushing uphill anymore. You've seen the map, you know where the wealth is flowing. The only question left is what you do with that information.